What's up guys, welcome back to the Daily Stock Picks. And in this video, we'll be finding out whether to buy Nvidia stock right now in September 2020, according to this article by Investors Place. So what I'll be doing for you guys is I'll be reading over this article with my beautiful voice, commenting, and we'll be conducting my own quantitative analysis to see whether Nvidia stock either belongs in our dividend portfolio or our value portfolio by using this checklist. So if you guys feel like being amazing, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. And now, without further ado, let's get this video started. So buy Nvidia for gains from games and profits placed on the pandemic. Nvidia stock benefits from dual entertainment and business catalysts by Josh Enomoto, Investor Place contributor. So technology stocks have been some of the unquestionable winners in otherwise disastrous market, coming to the grips with the novel CVPD. It's not hard to see why. Unlike the vast majority of the market, tech companies see CVPD as a tailwind. So it's no surprise that semiconductor firm Nvidia has exploded to blistering all-time highs this year at the time of writing. Nvidia stock is trading hands above $525. But even among tech firms, Nvidia elicits envy of its double CVPD catalyst. Let me explain. Nvidia stock has always outperformed thanks to its underlying graphic processing units, GPUs. Nowadays, video games are serious business, no longer relegated to a niche consumer base. Instead, it's a little weird if you don't play video games, a sharp shift from previous generations. Further, GPUs form the basis for playing some of the most advanced gaming titles at incredible frame rates. No matter what, Nvidia was going to benefit thanks to its leadership in the GPU space. But with the pandemic forcing everyone indoors, the narrative for Nvidia stock has become that much stronger. And personally, I think that games provide much more value, or like in terms of an entertainment perspective, when going to the movies. And as we all know, because of the CVPD situation, all the movie theaters and all public gatherings are closed. So just imagine you going to the movies and paying $20 or $30, you get an entertainment value worth for like 3 hours at max. Yep. But if you were to buy a game, you get like let's say a GTA 5, or if you guys played that, make sure that you smash the like button if you have. That gives you unlimited entertainment, right? It's more than 3 hours. They're constantly adding new features to it, so it's like a really good time killer, if you know what I'm saying. Yeah. So further, GPUs form the basis. We already read that part. Now let's have a look at this one. So I'm not just saying that based on an antidote. According to the information compiled by Games Sales Data and Nielsen, the US saw a 45% increase in time spent playing video games in March of this year. At the same time, France witnessed a 38% uptick, while gamers in the UK and Germany boosted their playtime by 29% and 20% respectively. In addition, video games are no longer played exclusively for recreation. For instance, many Formula One race car drivers are avid gamers, utilizing simulators to keep their skills sharp. Typically, ultra high-end gaming rigs are powered by Nvidia GPUs, thus further driving the bullish narrative. For Nvidia stock, servers matters too. Despite the enormous interest in video games during our new normal, Nvidia's management team would like you to know that Nvidia stock isn't just about gaming. That's according to Barron's contributor Max A. Cherney, who stated that the company is trying to push the investors towards its data center business. To be sure, Nvidia has every incentive to mark this burgeoning industry, according to Cherney. Nvidia executives have made the case that the company's networking business, the $6.9 billion all-cash acquisition of Israeli networking equipment maker Mellanox Technologies, is crucial to long-term plans too, because networking connectivity plays an important role in data center designs. Mellanox sales grew to $540 million in the fiscal second quarter, or 14% of the overall Nvidia sales. Granted, the data center business isn't as sexy as video games, but for Nvidia stock, this storyline is much more appealing over the long run. In recent weeks, many political pundits have noted the huge discrepancy between the record equity market valuations in the stock market and the economic desperation affecting low-income households. Perhaps most glaringly, the conference board measure of CEO confidence noted that the chief executives demonstrated a slight uptick in confidence. At the same time, the University of Michigan's Consumer Sentiment Index shows that every day American confidence lingers at multi-year lows. Cynically, the conference board notes that 38% of the surveyed CEOs expect to reduce their workforce. Moreover, 37% say they will trim their capital spending budgets by 10% or more. Of course, the execs are happy. Most of these tone-deaf high rollers spend their working days looking for even more clever ways to screw the American worker and juice profits for shareholders. CVPD provides the perfect opportunity for restructuring and fat trimming, and Nvidia's data center technologies help facilitate the shift towards automation. Cryptocurrencies present another sub-catalyst. Now, before anyone starts penning me hate mail, please note that I'm not implying that Nvidia is responsible for the destruction of the American workforce. CEOs are looking for ways to cut costs. With the technologies replacing or automating so many business functions, it is inevitable that Nvidia will find itself facilitating this disruption. This has nothing to do with how I feel about Nvidia stock, which is a name you want. That's because Nvidia diverse portfolio means that it's certainly receiving organic opportunities thanks to topsy-turvy world we live in. Most notably, cryptocurrencies are back in vogue. Due to the virtual currency's inherently democratic and accessible nature, I foresee the entire sector moving higher. ISO sharply rising prices makes cryptocurrency mining more economically feasible, and that would bode well for Nvidia's mining-centric GPUs. Of the high-flying names that we've seen this year, Nvidia stock is one of the investments that doesn't draw concerns about its premium. Sure, you should wait a bit for a discount, but the underlying fundamentals are so powerful across the board that you may not want to wait too long. Okay, so pretty bullish over here. So let's see what the current price to earnings ratio of Nvidia stock is. So current price to earnings ratio is 92.57, which is definitely higher than the S&P 500 index price to earnings ratio. So just by looking at the price to earnings ratio, it is definitely on the expensive side. Now, in order for a company to meet my dividend portfolio, it basically needs to meet 4 rules. And these 4 rules or principles are based on these 3 books, which I highly recommend checking them out. So the first rule in this principle is that rule number 1, the current free cash flows must be positive. So you want to be investing in companies that have a positive cash flows. So the higher the cash flows are, the better that the company is. And rule number 2 is that dividends paid out should not be more than 75% of the current free cash flows. So you want to be making sure that at least 25% of the free cash flows is being retained back into the company in order to grow its top line, or like make more money for the investors, or investing in new mergers and acquisitions, or paying out its debt. And rule number 3 is that it needs to have a consistent dividend history of at least 5 years, and generally 10 years is what you should be looking for if you want to be on the most conservative side. And rule number 4 is our buy criteria. We only want to be buying a stock when the current dividend yield is greater than or equal to the 5-year dividend yield average, making sure that the company is on sale at the time of buying the stock. Now, I like to use YCharts because YCharts does a really good pictorial representation of this financial information that we're after. So looking at this, we can see that the revenues have been increasing over the past 10 years, along with its free cash flows. If you were to see its free cash flows back in 2010, I believe that it was somewhere around $600 million. So multiply that. Let's see how many times it's doubled. So 600 double is 1.2, 1 double is 2.4, 2.4 is around 4.8. So it's not exactly 3 doubles, but it's somewhere around 20 to 25% year over year increase in its free cash flows if you were to look at the long 10-year time horizon, right? So the free cash flows are definitely a positive, which is a positive sign, and it's currently paying out $390 million as dividend. So 0.390 divided by 4.272, that equates to around 9%. So 9% of the current free cash flows is being paid out as dividend, meaning that the remaining 91% can be reinvested back into the business. So the dividend payout ratio is pretty good, and we shouldn't be worried about that cutting its dividends anytime soon. Now let's look at the dividend growth history. Okay, looking at the dividend growth history, we can see that Nvidia has been paying out its dividends over the past from 2013, but it hasn't been growing its dividends, meaning that it did cut down its dividends recently. So as a result, I wouldn't be looking at this stock any further, because we want to be making sure that the dividends that are being paid out do have a consistent dividend history, and the management's main perspective is to pay out dividends to its shareholders from buying into the stock. So I want to be making sure that the management is owner-centric, meaning that they are consistently increasing their dividends. As a result, it doesn't meet my dividend portfolio, but we can see if the company meets our value portfolio. So in order for the company to meet our value portfolio, it needs to meet 5 rules this time. And these are the 3 books that I've read, and the fundamentals are the backbones of these 5 rules. So I would highly recommend checking these 3 books out as well. And now, looking at that, rule number 1 is that the return on invested capital needs to be greater than or equal to 10%. So the return on invested capital just gives us the profitability of the company. The higher the number, the better the profitability of the company. And rule number 2 is that it needs to have consistent cash flows. So if the cash flows are 0, we wouldn't be even having this conversation, right? And rule number 3 is that it needs to have a strong balance sheet. So companies take on long debt in order to progress its growth or speed up its growth. It's like a time machine in a way. So we want to be making sure that the companies that have a long-term debt, that it can be cleared off from its balance sheet within 6 years or less than 6 years. The lesser the number, the better. Now, rule number 4 and rule number 5 are our buy criteria. We only want to be buying the stock when the current price is at least a 20% markdown from its fair price. And if rule number 4 isn't met, we can consider buying the company based upon its current price to earnings valuation. So we want to be buying the company when the current price to earnings ratio is at least 50% lower than the highest price to earnings multiple, and it must be lesser than the S&P 500 index. We know that Nvidia isn't lesser than the five-year index, like the S&P 500 index. So the rule number 5 is definitely out the door instantly. Nvidia, now let's have a look at that. Nvidia. Okay, the return on invested capital is 21.91. So definitely meets the criteria, and the minimum that I could find was back in 2011 when it was around 8.66%. So the return on invested capital, definitely a profitable company. We know that the free cash flows have been growing somewhere around 20 to 25% according to our rough estimates. The dividend yield is well covered. So consistent cash flows. Now let's look at the balance sheet. So we can see that the total long-term debt is around $7 billion, which it can easily clear off its current assets, which are basically the most liquid assets, which can be converted into cash within the coming 12 months. So if the company wants to do so, or the management decides to do so, they can clear this off within the coming 12 months, which is definitely a strong balance sheet criteria. Now let's see the intrinsic value of the company. The current earnings per share is $5.44, and looking at the ratios at which the company has been trading, or like trading over the past 5 years, we can see that the minimum was 16.97 and the maximum is 105.49. And the analysts are estimating that Nvidia, Nvidia, can grow at a rate of 17.44%. Okay, now what we're doing here is we're taking the current earnings per share, multiplying it by the analyst estimates year over year, and taking it for 10 years from now. All right, 10 years from now, we'll get the earnings per share as X amount, right? Now we need to find out the price to earnings ratio at which we should be buying the earnings per share so that we can get the future intrinsic value. A way of looking at this, we can either consider the 5-year PE average of 61.23, or otherwise we can multiply the analyst estimates times 2, we'll get the multiplication ratio. So we want to be considering the least amount, the lowest amount of these two, because we want to be estimating the intrinsic value on the most conservative side, making sure that we are not overvaluating or overshooting our estimates, because that can lead to a lot of problems, leading us to invest in the company at the wrong time. So the intrinsic value of the company is going to be around $806 per share 10 years from now, and the fair price at which we should be buying the stock is $229.21, and the right price that we should be consider buying the stock is $183.37, which is definitely lesser when compared to the current stock price of a whopping $504.90. So looking at this current valuation, Nvidia is definitely on the expensive side. I would hold on to the stock until it at least falls to our suitable levels, or if the company does start paying out dividends of at least 5 years down the line. Let me know what you guys think. Do you agree with this thesis or not? Do you have another way of evaluating this company based on its current criteria? So as a result, I would hold off on buying the stock. And the closing remarks for this article. On the date of publication, Josh and Amado did not have either directly or indirectly any positions in the securities mentioned in this article. A former senior business analyst for Sony Electronics, Josh Enomoto has helped broker major contracts with Fortune Global 500 companies over the past several years. He has delivered unique, critical insights for the investment markets as well as various other industries, including legal, construction management, and healthcare. And if you guys have stayed around till this part of the video, I really appreciate it. You are the hardcore fans of this channel. Thank you so much. And just full disclosure, guys, this video is for your education and your entertainment purposes only. There is no guarantee that you'll earn any money using the techniques or ideas mentioned in this video. This is not financial advice. Please consult your financial or your tax professional prior to making an investment in these companies. So make sure that you smash the subscribe button and turn on the bell notification icon, because we post videos from Monday to Friday if you want to get updated with the latest articles about the stock market investment. So catch you in the next video. Peace.